The case focuses on the data analytics and interpreted insights. So I don't really spend a lot of time on the underlying mathematics or the underlying tools to it, but really on how to get value out of the AI-enabled analytics. Next slide, please. I always like to start a conversation with folks like yourself with a bit of humor, but I want to emphasize 2 points. Quality of data is critical, but it is about the insight and not about how much data you have. And the second point is that AI analytics, to be most effective, really requires a balance between human judgment and AI-enabled capabilities. And it is very important that that be in mind, because it's all about the interpretation and then subsequent decision making and then action that results from that. Next slide, please. Just very quickly, I wanted to make sure how I use the term BI or data visualization versus AI-enabled analytics. And as you can see, data visualization, it's about data charting, dashboards, but it fundamentally answers the question, what happened and where did it happen? As you can understand, the maturity AI-enabled analytics really gets to 3 additional questions: why it happened, what will happen, and most importantly, how to make it happen. And today's session, or today's discussion, I wanted to go through 3 examples of AI-enabled analytics, show you how we use correlation in this particular use case study of a manufacturer to a distributor to an end product, how we use fair challenge, which is a form of scenario planning. And the third is the use of Monte Carlo simulation. Next slide, please. As you will see in the use case, one of the things that we search for is for changes in trend direction in order to monitor or correct underlying changes that will impact the trend. So on the top half of this chart, we could see that the trend is positive. And the question then becomes, what would actions or what decisions will you make based on this trend? However, when we implemented AI-enabled analytics, it does reveal insights that a visualized trend does not. And if you can see the bar in the darker colored bar on the bottom set under the January, there is a reversal of a positive trend. The point here is when you can identify this changing point, then you can take action to identify whether it's an anomaly, then use it to understand, is there a fundamental change in the market? Use it in many different ways. I think the case example that we're going to cover will highlight a few of those actions as a result of understanding a change in the trend by using AI capabilities. Next slide, please. I guess the point here is any use, as you well know, because this is the AIML FP&A committee. So I've gathered from Larissa, and obviously looking at the list of attendees, you're a very experienced group. So I don't believe I'm going to be telling you something you don't already know. But when I look at and apply AI-enabled analytics, I constantly have to even remind myself about the fundamental point of that you need to frame the question. And I use the quote from Alice in Wonderland: if you don't know where you are going, any road will take you there. And in effect, framing the question properly, understanding the discrete actions that you want to look for, and we will find in the use case some of those that we didn't intend to look for, is really where you harvest the value and the benefits of AI-enabled analytics. Next slide, please. So let's focus on three aspects, three applications that use AI-enabled analytics. The first was where there are disconnects in the supply chain. In effect, where there is a asynchronous relationship between supply and demand, between as you'll see in the case, the manufacturer to the distributor, to the store, and to the end customer. And so we're looking for what we call breaks in that flow. Second, and I will show you a couple certainly examples of that at a level of detail that I think will be very powerful. The next item that we want to focus on is predicting future trends to increase, in effect, to increase growth. So it's important to not only understand what the current historical trend has been, but what is the future trend? And particularly if it's you'll see, particularly if it's a positive that's going to continue, or if it's a negative trend that will reverse itself and become positive. And we have a couple of names for that in a moment, which I'll share with you. And then the third item that I wanted to share this today was how you can gain additional insight into cost savings and revenue growth opportunities. So let's go right to the next chart, if I might. And in understanding the use case that we'll be sharing, I just quickly want to give you a feel for the data structure. The three columns on the left, those are dimensions or attributes that define the record. The record being the field and the data time series related to it, which we'll get to. Then the next set of items are really our dimensions. So that those are ways we can roll up the data, we can aggregate it, or as that's like we like to say, is that's different ways that we can slice and dice the data to gain insight and to look for anomalies and look for trends and apply the analytics, the mathematics to any of the data. The field name is what is associated with the actual data item or the data record. And then the last on the blue highlighted is a time series, whether we are using past time, actual historical data, planned data, or forecasted data, or budgeted data, or planned data going into the future. And so, but it effectively is a set of time series. Next slide, please. So let's first focus on correlation analysis to manage the supply chain. Next slide, please. What we're looking for here is how synchronous the supply chain is, and how, and as importantly, how asynchronous the supply chain is. So let me just explain some of the columns that you see. What we did is on this particular manufacturer, we ran a correlation correlating the units sold to the distributor to sales, to the gross distributor sales. Again, we can run it against external data. We can run it against other internal indicators. But in this particular case, and I've chosen to use this particular example, was to highlight where the correlation is. And if you look at the screenshot, and under the column labeled, obviously, correlation, there is both the value, the likelihood, in effect, R square of the coefficient of correlation. And what we've done is to make it a visual. So there are green bars that give you the same kind of indicator, analog, to your smartphone, how strong the signal is. So if you have no bars, it's a weak correlation. If you have 3 bars, it's a strong correlation. And so it's a visual cue to understand the correlation. And so now what we find is where there is no correlation, that could represent a asynchronous supply chain, because the units distributed, the correlation of units sold to the distributor, is not correlating with the revenue. What that implies is that could be to the distributor an oversupply of inventory, or it can imply an undersupply or a stock out where it doesn't have enough product to sell and share. Either way, this gives us a signal to the analysts that there's something that needs to be better understood and potentially to lead to a corrective action. It also, to the distributor and to the manufacturer, ultimately, it could also represent lost sales. So in this case, there's a direct impact on your revenue, on your operating performance. And the third, and we'll get to that in a few moments, it can also have an impact on product profitability. So just by understanding this correlation, there's a number of analytical insights that you can draw from in terms of what is happening, why is it happening, how do we deal with it, how do we manage with it, and what can be done to correct it if it in fact is not just a one month trend, but becomes something that is much more sustaining. Next slide, please. The reason why I included this particular example is, instead of searching for every disconnect, what we did is we just said, show us where all the units, distributed units to sales, where there is no correlation. And so what we've done is we've isolated and highlighted by store. And in this particular case, we actually did it by product, so that you can then really focus in either through your sales organization or your, depending on how you're looking at this, whether it is a procurement issue or sales and marketing issue. But certainly knowing that there is no correlation, even though there are positive and some unfavorable variances in the business results, becomes a very important cue on what actions to take going forward. Next slide, please. So what we've done, and we've classified future trends into 4 basic categories, and we kind of give it some fun names. All right, the first one is what we call a head fake. This is where a bad trend that's predicted to get better. Then next is bad is bad. That's a bad trend that's predicted to get worse. Then we have what we call the big bad wolf. This is where a good trend is predicted to get bad. And the fourth is what we call Christmas. It's a good trend that's predicted to get better. And we have found that the last two are the most important to taking actions and understanding its impact on growth. Next slide, please. So let's look for these four types. Remember, Christmas is where a good trend is continuing to get better. And as you can see, and again, I know it might be a little difficult for you to see the detailed numbers, but this is intended to be visual more than the actual values. So there we have the green arrow, which is saying that the predicted trend is positive. It has a favorable year-over-year variance in terms of gross distributed sales. And so what we're seeing is a Christmas. This is a good trend that's predicted to get better. Then if we look down a little further, we see a negative trend that is predicted to continue to be negative. And that's what we call the bad is bad. Then if we look right further down, where we have red in the variance column, but a green arrow pointing up, that's what we call a head fake. That's a bad trend that is expected to get better. Now, this is important because you may want to focus on a bad trend expected to get worse, not to improve. Is focus some effort within your sales organization or somewhere within the organization to analyze the underlying root causes of that. But where you have a unfavorable or negative year-over-year units sold, sales, but it is forecasted to get better, you may want to not apply as much time to that, or you might want to monitor it differently. You might feel that it's sustaining because you may have run pricing, or you may have run advertising programs, and or there might be, like we are unfortunately in this post-COVID-19, where there was a lull in the March-April timeframe, and then with all the movement towards work from home, and again, this is a monitor product, the office supply product, there was a real pickup. And so the overall year result was unfavorable, but it is being picked up because of the transition, the rapid transition that we all know to the work from home. So there's ways to use this data, as I said at the very beginning, to analyze and understand the implications of it. And again, we can go through each of those, but I'm giving hopefully a flavor of what this provides. Next slide, please. In this particular case, what we did is just the opposite of what you saw a few moments ago, which is we want to find the big bad wolves. These are good trends predicted to go bad. And the implication is to understand the why, and how do we then take action so we don't lose these positive results, because something is going on in the data and we need to understand it. And again, one of the things that this is this information occurred in prior to the COVID-19 economic effects. If it had occurred in this recent period, we can adjust the model for those changes, either by lagging or by changing some of the mathematics as it relates to it. But I just want everyone to understand these were pre-COVID results. But here it is looking for where we can take action to reverse what would become a negative results, but it's like closing the barn door before the horse leaves the stable. Next chart, please. I just want to highlight here again, using this information, that you can see that on a year-over-year basis between 2017 2016, that the number of orders decreased from 2016 to 2017. Okay, but the amount of revenue increased, and is forecasted to, or predicted to, increase. So what does that tell us? It tells us there's an opportunity from an activity-based costing perspective that we can have more efficiency of our distribution network by taking advantage of larger volumes within each order, and therefore reducing any of the attendant costs to the order, such as freight and other handling type of costs itself. Again, another opportunity to use AI analytics. Next slide, please. Fair challenge. Next slide, please. And again, what do we mean by a fair challenge? Well, the classic example to a fair challenge is where I was recently a CFO of a $2 billion organization, and I was in their technology division. And the head of the company, the CEO of the company, came to me and said, you know, Larry, I need us to improve our revenue by 10%. Well, I got to figure out how to do that. And so what I did is I used Fair Challenge. In this case, we used Fair Challenge for this particular use case. Next slide, please. So what we've done is we put in what the value is current, whether that be your budget value or historical actual value, what the challenge value is. In this case, I use a 10% increase. And what we have is on the lower right, the cumulative probability, which is 20% to achieve this challenge. But more importantly, not only is it we have the cumulative probability, but we can see where it is cumulatively by or discretely by each of the stores that provide this particular product. Next slide, please. So now what I've done is I've changed that. I'm sorry, one back, please. This case, I change it to a 5% increase. Here you have a 34% cumulative probability. So you can see where you have opportunities perhaps to be able to meet the stretch target, but you really can focus in discreetly on what stores are most opportune to achieve that. Thank you, Larissa. Next slide, please. And so the third area that I want to cover is the use of Monte Carlo simulation. Next slide, please. So what we've done is we've taken basically the sales data for this use case. And then we've run a Monte Carlo simulation for across all of the total revenue in this case. Next slide, please. I'll show you the results. And so what we now have by period, in this case, it's a forecasted period, again, pre-COVID-19. We can see what the mean is, that purple line in this, that's obviously the mean, and then what would be one standard deviation, or approximately 67% from the mean, and then two standard deviations, 95% likelihood, probability, and then the red is three standard deviations, which is 99, I think 99.7 probability. As a Six Sigma trained person, I like to think in terms of standard deviations, certainly up to Six Sigma. Anyhow, what is the implication of this? It's not just to run the information to see its variability, but you can make decisions off of this. If we see that the red peak in September of 2020 will be 3 million, in this case, revenue, or 3 billion, or whatever that number is appropriately to be. But to get to that forecast, and let's say this is a forecasted data, the likelihood of that happening, it does not have, it has only a 67% probability. Oh, I'm sorry, has a 99% probability that it would occur if it's going to be achieved from the mean. But I don't want to imply with this that it is 99% probability that you will achieve it. It just shows what the variability needs to be in order to achieve it.